Joining us now is Brian Jacobsen, Chief Economist at Annex Wealth Management. Brian, thank you so much for joining us this Monday. Let's talk about the latest on the geopolitical front between these rising tensions between Israel and Iran. Over the weekend, you had Iran respond with both missile and drone attacks on Israel. As it relates to the market impact, on Friday, you saw classic risk off. You saw oil shooting higher. Today, you have oil coming down a little bit when we look at West Texas Intermediate. Futures now higher. What signals are you watching to see if this is going to be maybe a true economic disruption or more of a sentiment shock?
Yeah, thank you for having me. And I think that it's really important from a market's perspective that we keep in mind that the U.S. economy is in a very different place today than what it was during previous Middle East conflicts. We're a net energy exporter. If we look at the share of people's income that goes to gasoline, on average, it's around 2.5 to 2.6%. Now, clearly, there are differences amongst people in different income strata, right? People in lower income strata, they spend a larger portion of their budget on gasoline than people in upper income strata. And so in terms of the economic effects, I think that it's going to be fairly well contained for the United States. Obviously, everybody's concerned about the toll on human life, but then also what about the Straits of Hormuz, where 25% of seaborne oil gets shipped through? It looks like there isn't going to be an effort to close that off on the part of Iran or to maybe harass ships as they go through there, because they're very much focused now on retaliation and defending themselves. And so I think the market is sending a signal that yes, there is this risk, but it is more like a tail risk as opposed to a base case scenario. So I don't think it's going to have a longer term economic effect on the U.S. or even the global economy.
Okay, so that's good perspective. And then, given where we see oil off just 1% now, trading around $72 a barrel. So you think because there's not expected to see the disruption to the Strait of Hormuz, that energy markets may have overreacted on Friday?
A little bit, yes. And also keep in mind, we're West Texas Intermediate, and I know globally it's more about Brent, but WTI is still down about 6 to 7% from where we were on April 2nd, Liberation Day. Saudi Arabia, they have decided that they're going to try to increase production. They have plenty of spare capacity, and this is part of the kind of relationships amongst OPEC trying to punish those countries that aren't fulfilling their end of the quotas. And so you do almost have a price war going on within OPEC. And I think that Saudi Arabia has the capacity to really fill the void of any disruption that we might see coming out of Iran. Iran is only about 1% of global production. And so I think that really the oil market understandably reacted negatively to this, but it does seem like it is a bit of an overreaction.
Okay. All right. We'll continue to monitor. Let's talk a little bit about the state of inflation heading into this week's Fed meeting. Now, when we look at the CME Fed Watch tool, the consensus is we're not expecting a move on rates, but CPI, PPI both came in tamer than expected. There were some bits that were, if you look under the hood, some segments where there was still some heating up. How do you think this impacts the Fed's interpretation of where inflation is?
Well, I think that it really does. And it's mostly because there's just a little bit more clarity around tariffs, maybe an upper limit as to where they might go. And even though it is likely still to create some disruptions and some drag, as long as it improves sentiment. So it's the direction of change as opposed to the level of sentiment that I think is going to perhaps help the markets and even the economy. We know that the uncertainty led to hesitancy, which has led to a slowdown. If we get some clarity, we could get some stability and even a return to growth.
Okay, and let's talk a little bit about trade policy as it relates to the U.S. and China. We'd come away with that, new agreement. You had originally had the Geneva. You had parties come back to the table in London. So you have the London piece of the puzzle there. It buys some time. You have rare earths guaranteed for several months. Do you think that this there's still some fragility when it comes to this, or does this give kind of a firmer picture when it comes to the U.S. and China on trade policy?
A lot of it is in China's court as to do they actually export the rare earth minerals. It seemed like it was one of those situations where the U.S. said, okay, you fulfill your end of the bargain first, and then we'll fulfill ours. I'm confident that they will. I think it's in their economic interest to do so. And if they only have this agreement in place for 6 months, that is a broad window for them to negotiate more of the details. It's not necessarily the level of the tariffs, which, at about, let's say, 30%, I think President Trump put a post out saying 55% on China, but that includes the 25%, sector specific, 30% kind of broad based. So kind of doing the math, it looks like maybe 30% tariffs on China, China tariffing the US 10%. It's not great, but it is much better than what it could have been. But now it's really about all the other details around market access, export controls, all these non-tariff trade barriers. And a 6-month window, I think, is enough time for them to continue to make incremental progress. So it might be moving at a snail's pace, but as long as it looks like the talks are like 2 steps forward and only 1 step back, I think that the market is going to be able to digest whatever comes out of those talks.
I like the way you put that, 2 steps forward and only 1 step back versus doubling back. All right, Brian, thank you. That's Brian Jacobsen, Chief Economist at Annex Wealth Management. Always great perspective from Brian.